I'm going to start off by, most of you know me. Some of you are new to the community. I want to start off by just introducing myself. I'm Param. I am a radiologist in Southern California, a mom. I started real estate investing 10 years ago. I was able to use real estate to get to financial freedom at 41. And then I cut back on medicine. I tailored my life the way that it made sense for me. I had the freedom to do it at that point. And while doing it, I realized that we don't necessarily talk about money or finances in general as physicians when we gather together in the workspace. And there's a path to financial freedom that is much faster than the traditional retirement model. That's when I went ahead and built out Generational Wealth MD. That's the community where we now have over 10,000 members. Most of them are physicians. I believe we're 80% physicians in the community. And I talk about, real estate per se, but the goal has always been financial freedom and to help everyone accelerate that journey. And then we built out GW Capital because we saw that the majority of our members were interested in investing passively in real estate with us in apartment complexes so that they could be very hands-off and still benefit from the significantly increased returns that you get from real estate. And GW Capital at this point is at 1,000 plus stores with our latest acquisition. We're going to talk about that briefly. And we're at over 185 million in assets under management. And all of that is thanks to all of you. The trust and support has been humbling. Again, we continue to bring our community vetted, curated assets where we try to stay conservative, but still give you those highest risk-adjusted returns. And we partner with sponsors across the country to bring you sponsor diversification, market diversification, while constantly vetting and ensuring that the deals meet our stringent criteria. And I always like to mention GW Gives. This is the nonprofit part of GW Capital. And I want you as our investors and as our community to take pride in what we're doing. A big part of the GW mission is to help children with disabilities in rural India, to empower them with education and healthcare. And I want all of you to have a sense of pride in it. You make it possible for us to go ahead and take this mission forward. We're currently helping kids with, these are communities where this is where I see the highest inequity. This is where I see fathers abandoning their families because there's so much social stigma associated with having a child with disability. This is where we have the highest impact. We're helping kids with hearing disabilities, visual disabilities, thalassemia, chronic disorders, intellectual disabilities, and we just want to keep growing this mission as GW Capital grows. So thank you for being part of this. And then this is something I'm very excited about. Before we get started, we just put out a free guide. And I've been working on this. I know that in the past, for anyone who wanted to be a passive investor, we've recommended The Hands-Off Investor as a great book. It still is an amazing book by Brian Burke. It's a great resource. It is also very extensive and it can be a little dry and hard to read. And so I wanted to put together, this has been long due, I wanted to put together a simple guide where if you are someone who's just beginning to invest in real estate passively, or if you've been doing it for a while, but you wanted more guidelines in terms of, knowing what kind of deals to invest in, what makes sense for your portfolio, because I believe real estate is very personalized, understanding how to vet a market, deals and sponsors, because, we are operators ourselves. And I still feel like the most important thing that you can do for yourself is really educating yourself. And a big part of what we do is educating our community. And so it's all about vetting the market, vetting the deal, vetting the sponsor. How do you do that? And we actually have a due diligence checklist in here. So it's like, okay, these are the questions I need to ask. This is what I need to look for. So you're able to take due diligence into your own hands. And I would love feedback. So if anyone, you guys, it's available at generationalwealthmd.com/guide, all lowercase. So if you go through it and you have any suggestions, this is, we put it out like a week ago. So we're just beginning to talk about it. Any suggestions, any feedback, what you loved, what you didn't love, feel free to shoot us an email at generationalwealthmd@gmail.com. I'd love to hear your feedback. I'm hoping this is super helpful. I was very excited putting it together, so I'd love to hear from you. And so definitely download it. If all you're looking for is a quick checklist, we have that towards the end. If you're looking to understand everything from, okay, what does an operator mean when they talk about value add versus a core asset? Now, I don't even know the basics. We have all of that in there. What's an IRR? What's AAR? All of that can seem very confusing, but honestly, it's just mathematical. It's very simple and formula based. And so I tried to simplify it. So yeah, I'd love to hear feedback. But sorry, guys, I'm just recovering from a cold. So forgive me for clearing my throat often. I want to start off now with state of the market. Okay. And I'm very excited. We love to do state of the market. The way I like to do it is talk about the pain points right now. So the bad, then talk about, the bad and the ugly first, and then talk about the good. Fortunately, if you've been listening to our prior state of the markets, things haven't shifted much. We are having a kind of smooth transition as we progress along the year. And I'm going to talk about it. Everything that seems bad also has a plus to it. I was putting these slides together and I was like, okay, let me talk about the bad first. And I was like, well, but there's so many positives to this. So we're just going to do it sequentially. I'd like to start off by talking about interest rates and inflation, because that has been a huge pain point, right? All of us know now this is data. This is national historic data over a decade that we have over here, this particular slide. It's not the most up-to-date, but it seems like the most relevant. So I didn't put in the most up-to-date slides. This actually explains the data better. So if you can look over here, where is inflation over here? So the green line is consumer price index, which is a reflection of inflation. Every time inflation goes up, the Feds increase interest rates in an attempt to control inflation, right? And so that's exactly what happened with us. There was printing of money that happened during the pandemic, led to massive inflation. That's the green line over here, going all the way up to 9%. Inflation, typically, the government likes to have it between 2 to 3%. That's a normal rate, right? And inflation peaked at about 9%. And in relation to that, if you look at the red line here, this is the Fed funds rate going up. The Fed, they had to increase interest rates over time in an attempt to control inflation. Now, the good thing is that inflation peaked at 9%. It is now down to 3.2% based on data from July. And so that's significantly low. I believe June was 3%. So they're getting it close to that 2% target that the Fed has for inflation. So it's pretty close to that. What we have seen, usually the interest rates dropping, that tends to lag by a period 6 to 12 months. And so what we have been seeing is that even though inflation's dropping, interest rates, we did have a rate hike in July, and the Fed fund rate went up to 5.12%. That's where we are. Now, what most of us anticipate is that this is possibly the last rate hike that we're going to see. We're possibly not going to see interest rates drop for the next 6 months, but first quarter of 2024, that's when we're anticipating rates to start going down. This is just the norm. This is how it usually happens. We have historic data. The next slide is that to demonstrate that. So everything is trending the way it should. And this is actually positive data. Also, this slide is also here to show you how, historically speaking, interest rates aren't as high as they have been in the past. In the 1970s and the 1980s, it was super high. So historically, interest rates aren't that high. We're on the path where we're probably going to plateau now for the next 6 months and then drop, which is a good thing. And overall, I like to say inflation usually benefits real estate investors. And that's because real estate is an inflation-adjusted asset, which means, and this slide just goes to show that, every time the orange line is actually NOI growth, net operating income growth, so income from real estate, that fluctuates along with inflation. Every time inflation goes up, your net operating income from real estate also goes up, and that just goes to show that real estate tends to be recession resilient because it is inflation adjusted, right? And so inflation being high, interest rates being high, they're not necessarily doomsday scenario. We now know where we're trended, and that's where we're headed, and that's a good thing. This is, again, historic data to show that typically it's 24 months between the first hike to the first cut. And so the prediction always was that in Q1, or between Q1 and Q2 of 2024, that's when we're going to start seeing the first hikes. We're on track to be there. And so as long as we are strategic, we understand that's what's going to happen, and we have the ability to hold on to our multifamily assets. Now, that's different from any of you who own real estate using conventional financing, because you possibly have a 30-year fixed rate over there. The rate going up probably didn't affect you as much if you already acquired your assets, right? And even if you're acquiring, there are strategies around that. Now, this is mostly for those with commercial loans. So as long as you have the ability to hold, you're going to do great. And we talked about the trend. So again, these are the forward-looking SOFR curves. And again, we're anticipating rates to start hiking down beginning. So possibly Q4 of 2023, but definitely Q1 of 2024, we're going to start seeing those rates go down. And that's going to provide a lot of relief, which is a good thing. While we're talking about state of the market, the other important thing to remember is that there has been a plateauing of rent growth. Now, this is important for anyone in real estate because oftentimes projections are based on rent growth, right? So this is definitely an important thing. But again, the positive is that, 2021, 2022, we saw massive hikes in rents and in property prices. And so if you actually look at year-to-date rent growth, we're actually just seeing things stabilize. So it's not as bad as it seems. We're just not seeing the same rate of growth as we did before. And most conservative operators have these numbers figured in already or already underwriting conservatively. And so it's not, it's just a reset towards normal. And then we're likely going to see rents start increasing again towards the end of this year or in 2024. It's going to head back to where it normally is. So it's just a reset, kind of accounting for everything that happened in 2021 and 2022. Again, the rent growth is also, real estate is always hyper local. That's what we say. And you'll notice that the different states have noticed different a different degree of resetting, essentially. If you look at Las Vegas and Phoenix, you'll notice that they've seen almost some negative rent growth. Now, for those of you who are invested with us on our Phoenix assets, we have the data. I will actually show you the data. We're actually, because of the value add plan, right? Now, in real estate, in value add multifamily, which is a sector that we tend to be in, we're not just banking on market rent growth. We have a plan where we go in and we rehab the properties, right? So we're actually controlling rent growth, and you'll see that rent growth has been consistently heading upwards, even in Phoenix, in Greenville, in Atlanta, where we hold our assets. And so this isn't something that we need to be concerned about when you have a value add plan, but it's something to stay on top of to make sure that you are only putting money where you are seeing that rent bump, right? And we can talk more about that as we talk about those assets. But you will notice that Indianapolis heads the country in terms of where we're seeing the highest rent growth. And that is partly because they didn't see the massive increase in rent that the Sun Belts did, right? So it's just that they're not seeing the massive reset that some of those other markets are seeing. But that being said, that's why the current asset that we have that's open for commitments, Park 33, is based in Indianapolis. So understanding this data really does help us to, redirect our portfolio where it's still making sense. Now, again, the positive thing, and we talked about, like I said, I'm trying to look at, okay, so what's the bad and the ugly, but there's always good attached with it. Income growth has kept up with rent growth, and that's what we want to see, because that just means that inflation hasn't taken away purchasing power. It hasn't taken away the ability of our tenants to pay, right? And so income growth has kept up with rent growth. That is a positive. I'm so sorry about the noise in the background. It's always the most inopportune time when landscapers are here. But let's keep going. Hopefully it isn't affecting voice quality as much. It shouldn't. Anyways, let's talk next about housing affordability, right? So the next big question is going to be, and so this is a concern, right? So this is technically, if you look at the overall economy, it is bad. Just because of the way interest rates are, at least a year ago, the cost, if you wanted to, the cost of home ownership is significantly higher than the cost of renting. But the positive is that if you look at it from the perspective of an investor, it does increase the demand for rentals. And so overall, that does, and that is another reason why we're still bullish about multifamily, because you are providing more affordable housing options, right, in the current environment. So that does hold true. That still holds true. And again, just goes to say that it's much cheaper to rent right now than it is to actually own a primary residence. Just data to support that. Again, when we're talking about, again, whenever you think about there's recency bias, right? When we think about the housing market today, it's very intuitive for people to think about 2008 and try to draw parallels. But the important thing to remember is that where like this curve really shows you how the demand supply curve was lopsided in '07 and '08. And if you look at it now, we are actually in a stage where demand is significantly higher than supply. And so you have to understand that the dynamics are not necessarily the same. So again, this favors investing in multifamily and investing in housing at this point. So again, that's positive for those of us who are investing in real estate. Just data about the GDP changes. Technically, for us to be considered to be in a recession, we've talked about this in the past, you need to have 2 consecutive quarters of negative GDP growth. We are not there. And I think more and more people are talking about, while there was more talk about going into a recessionary period 6 months ago, I think more and more people are talking about a soft landing right now and possibly not seeing any massive impact to GDP as opposed to what we were expecting previously, right? That's another important thing to remember. Now, the other thing I want to talk about is job market, right? And so most of you know this, unemployment is still at 3.5%. So we're still not seeing the job market with inflation and interest rates going sky high. We still aren't seeing it impact the job market significantly. Pros and cons, it gives the Feds the ability to hold interest rates higher because they still have, they have a mandate where they need to get inflation to where it needs to be. And the other thing they are tracking is unemployment, and they haven't seen a huge impact over there. But overall, that does bode strongly for the economy in general, and so that's a positive. Same thing with bank reserves and household net worth. Again, this is very different from what it was in '08. We are, and this is data from June 2023, right? So like we're a month and a half in terms of data. We're still seeing strong household net worth and reserves, and that is a positive sign. And so again, we're not in the same environment that we were in '08, essentially. This just goes to show that among the different asset classes within real estate, apartments tend to be very recession resilient. This is what happened in '07 and '08. Vacancy spiked a little bit for multifamily, but not as much as it did in other asset classes, which is why we, especially this time, we like to stick with multifamily because it tends to be evergreen, right? The self-storage and industrial really did well also during COVID and post-COVID, but we are seeing a reset in self-storage just because the demand that existed during COVID hasn't necessarily carried through. And multifamily is just like it's evergreen. There's always been strong demand, and we continue to be very bullish on multifamily. Now, this hasn't really changed much. For those of you who've been with us the last 2 quarters where we did our state of the markets, how are we recession-proofing our multifamily portfolio? It really hasn't changed much. We have been in, so if you look at market cycles, recession and recovery is like the lower half of the market cycle. We've kind of been in that space for the last 6 months. Anyways, we've been very, very conservative about how we're acquiring and where we're acquiring. Hasn't really changed much, but just to recap, right? How do you recession-proof multifamily? How do you recession-proof your portfolio in general? Multifamily is different because we're talking here about commercial loans, right? So this is specific to those who own real estate with commercial loans on them. Again, strong landlord-friendly markets. Our latest deal in Indiana, again, a very strong landlord and business-friendly market. Excuse me. That's what we're looking for constantly. We're not relying on market appreciation. So especially now, we want to go into deals that are super conservative. And when I say conservative, it means that from day one, we have adequate cash flow. Actually, we want to have higher cash flow. We want it to be, so that the deal we have in Indiana is a core plus deal. And for those of you who want to learn more, that's in the guide. So just download the guide and I talk about the different asset classes. But what it means is that it's a newer build with higher cash flow, and its day one cash flow is 5% for anyone in Class B. And that's pretty high for an asset where we haven't even executed the business plan, right? And so going into positive cash flowing deals, higher cash flows, what we're looking for, newer deals, less variability, right? But still having that value add plan where we are able to control our returns because we're tapping into tax efficiencies, we're tapping into the value add plan. All of that does exist. And like I said, the big thing is going to be the ability to hold till the market resets, interest rates drop. And as interest rates drops, we're going to see a compression of cap rates. What that means is that multifamily prices are, real estate prices are automatically going to go up as interest rates drop just because purchasing power increases. So as long as we have the ability to hold till 2025, where we're going to start seeing that shift in the market cycle, we will do well, right? And so to be able to do that, and this is specific to commercial loans, to be able to do that, we are trying to hold adequate cash reserve. That's going to make or break things. Have the right kind of debt that's going in. If you look at the deal we have in Indiana, it's a 3% loan that we're assuming from the sellers, fixed for the next 7 years, right? So that's the kind of deal that's the kind of deal where the numbers make sense. Because if you look at deals where the interest rates are, say, 6% and the cap rate is 5%, that's actually negative leverage. For those of you who don't understand cap rates as well, what I want you to realize is that cap rate is when you purchase an asset all cash, right? If you didn't have a mortgage on it, what is your return going to be in terms of cash flow? That's all that it is, right? And for most assets right now, it's going to be between 4 to 6%. But if your interest rate is higher than your cap rate, then end of the day, you're negative, right? So using leverage negatively, your cash flows, you're going to be negative in terms of cash flow. And that's where it becomes important to have the right kind of debt so you're able to stay cash flow positive and stay conservative, right? Conservative underwriting assumptions, all of that is super important. Like I said, rent growth is slowing down. And the other things that, I think most of you understand this, insurance costs have gone up, property taxes have gone up, and that's because of the massive increase in property prices that we saw in 2021 and 2022. Once you factor all of that, it's really important when you're looking at a deal to look at it differently now compared to how I would say they were being underwritten maybe a year ago or even 2 years ago. And so all of that is going to be super important if you're going to recession-proof our portfolio. For those of you who own real estate directly, it's the same concept for all of us, right? And so how are we adjusting multifamily investing? This is the same slide. I literally went in and I was like, okay, what are we doing differently? We've been doing this for the last 6 to 9 months. So nothing has shifted essentially. The loans that we're getting, the last 2 deals we got into were assumable debt deals. And what that means is that we're assuming the loan of the seller. And it can get a little complex in terms of how that is done. And there are very few of those deals available, but it allows us to lock in interest rates that are under 4% in an environment where we'd probably be about 6% if we were to get a new loan today. And therefore, it makes our deals cash flow better, right? So that's something we're doing, purchasing assets that are discounted. Again, that just gives you built-in equity, which is amazing. We are, depending on the deal, we've reduced our loan to value, right? So we want to take as little leverage. We want to be conservative in terms of how much leverage we're taking. For some of our deals, depending on if they're super high in cash flow, we may be able to go in at a 70% loan to value. For some of those deals, we've been closer to 55% just because we want to keep the deal safe, right? So it depends on the asset, it depends on the business plan, but we've been very conservative. I believe I know of sponsors who've been at a 90% LTV with some of their deals, and those are the deals, especially if they were acquired in 2021, right? Late 2021 and early 2022, when they didn't really see the upside in rents after acquisition. That's when they're in trouble. That's why structuring your loans appropriately makes a lot of sense. And we've been very conservative in our LTVs. And we've tried to get fixed debt or get really tight rate caps whenever we have gone in and gotten new loans on our properties. The most important thing is to have flexibility. Say a year from now, 2 years from now, you want to have flexibility. You want to be able to hold on to those deals if you need to, but also have the ability to exit, do a refinance. So having that flexibility has been super important. And towards that, what we've done is, you've seen with some of our deals, you'll see that we've shifted from doing a platinum renovation to going partial because it reduces our cost. We are possibly able to get a higher ROI for that renovation. And so making those strategic shifts, keeping our finger on the pulse, that has been super important. And then you'll see in some of our deals, we've also, instead of going and doing a capital expenditure, CapEx draw from the lender, although we have it in our plans, we try to use our cash reserves to do our rehabs as much as possible because that reduces it reduces the loan on the property per se. Instead of going and drawing more, we try to use what's at hand, and that gives us a little more flexibility in terms of structuring things and having more cash reserves and having a higher cash flow and being able to meet those DSCR, the lender requirements essentially that are required for us to be able to hold on to the asset, right? So those are the shifts we've been making. Again, I want to go into more detail, but this is like generally overall, this is what we've been doing with multifamily lately. And I think we're strongly positioned to take advantage of the opportunities right now. Because like I said, what's happening right now is that we're seeing cap rate compression. What that means is that people are willing to pay people are paying less for a certain amount of net operating income, right? For a certain amount of cash flow. But we anticipate that by 2025, as the market cycle shifts, as interest rates drop, cap rates are going to compress. And what that will mean is that people will be willing to pay more money for the same net operating income. So when we are going in and we have a plan for value add, we're increasing our income. What happens is that, and then if cap rates are compressing, then we're able to take advantage of both of that. So instead of standing on the sidelines, we're going in with a conservative plan. And that's essentially what Warren Buffett said when he said, be countercyclical, right? And so this is the time for us to make conservative use of the opportunities that are actually available to us, right? So we're not trying to time the market. We are trying to go in and take advantage of what's actually happening in the market. So again, if any of you have any questions regarding this, drop it in the chat. I see 2 comments in there. I'm going to go and take a look at them towards the end. But that being said, I think when I look at it, the environment today, right? I think the biggest question you should be asking yourself is, where should you be putting your money? Right? That's the only question. So we're not trying to time the market. We're trying to take advantage of the opportunities that are available. So the 2 questions that you're going to think about are going to be, okay, so what am I going to do with my money? Where am I going to put it, right? And so if you look at the stock market within the current environment, like let's not talk about what happened in 2021 and 2022. Every asset did really well then. And then because real estate is leveraged, it did significantly better than the stock market. But that being said, right now, and Vanguard's perspective was we're expecting 4 to 6% in the stock market, and cash is losing value because inflation's high. That being said, real estate is still a very, very tax efficient asset class to be invested in. It's inflation adjusted. Like I said, you have cash flow from day one, but you have the ability to bump up that cash flow and increase the value of the property. So we have a lot of things in our control as opposed to the other asset classes that are more market driven, right? So we're not looking at market price appreciation. We're controlling things over here. So I still feel like this is a great asset to be in. That's why we continue to be bullish. And I wanted to present quickly, before we talk about our current assets in our portfolio, quickly talk about Park 33 in South Bend, Indiana. And so for those of you who are beginning to explore real estate, right? So I want you to get an idea of what we're looking at right now. Now, what you have to understand is that in the current environment, like we talked about, right? We talked briefly about cap rates. And cap rates are decompressing. And what you really want to see is that the interest rate that you're getting essentially needs to be lower than the cap rate for you to have positive leverage, right? So you do that when you get loan assumptions, like we're doing with some of our assets. The other, the other strategy that some of the really, the sponsors that I know are employing right now is they're doing build to rent. So what is build to rent is when it's ground up development and then, and then selling the asset when it's ready, when it's cash flow ready, right? And that's another thing that, again, makes a lot of sense because that's the only way to make the numbers work in the current environment. But there are definitely way more variables in a build to rent scenario because you're starting it from scratch. And so what we've adopted is going into assets that are still cash flow heavy from day one. So what we call stabilized value add assets, which means that the asset is stabilized. If you went in today, like this asset over here, Park 33, it's greater than 95% occupied. They actually have a wait list. It's about over 98% occupied. It has been at any given time. And that's because of the demand. But it's also a core plus asset, which means it's a newer asset that just has a higher cash flow, right? So those newer class A assets tend to have higher cash flow. So when we're going into an asset that's cash flow heavy. We're going in with a loan that is at 3% because we're assuming it. So we're actually making those numbers work. And that is where we prefer to sit right now with the way the environment is, as opposed to going into the build to rent or trying to find other strategies that can give you the same returns, but do have a slightly higher risk element. So what we're doing is we're going the opposite direction, shifting towards core plus assets, and then adding a two-phase value add plan over there and bumping it into the value add space. So going into something that's more conservative, but then boosting the returns by doing the value add plan that we have. If you want to learn more about this, it's generationalwealthmd.com/Indiana, lowercase. That's where you can learn more. There's an investor webinar in there. We are fully subscribed for this deal, but we are at the point where we have a handful of investors who haven't funded the deal per se, have soft committed, but haven't funded the deal. And so we have maybe 2 or 3 spots left in this deal, only for the if you can get in really quickly and fund within the next week. If you are interested in doing that, get onto the site, generationalwealthmd.com/Indiana, lowercase. Take a look at it quickly and then book a call with someone on the team if you want to get in. But we only have a few spots. But I think the most important thing to highlight over here is, for those of you looking at deals per se in this environment, that's what I want you to look at. I want you to look at the risk return profile. And that's a big part of why I came out with the guide also. So go through the guide, and it's going to help you understand what your risk tolerance is and try to find deals that kind of match your risk tolerance, right? So that's what's important. So you could go higher risk and higher reward, or you could be more conservative and go into more cash flowing deals that are stabilized, that do give you the high returns also. And so just be very intentional about how you're picking these deals. And I think that's what I wanted to highlight over here. What else? Market highlights. We talked about Indianapolis being one of the markets with the highest rent growth currently. That's another reason why we're very bullish about this deal. Again, it's a very strong market, close to 3 major cities. Again, it's a 2-phase value add plan. We go into deals that are cash flowing and then bump up the rents. And as you increase in multifamily, when you increase the income, you're increasing the value of the asset. It is the same plan that we've executed before. The fact that we're going in with that 3% fixed rate loan for the next 7 years, that's federal, that's agency debt. Again, very safe debt, gives us the positive leverage and strong cash flow day one. So if anyone's interested, make sure you take a look at it. We only have very limited spots at this time. And then you need to be able to fund within a week if you want to get into the deal at this time. But let's move on to performance for the other assets we have in our portfolio. I know we have some of our investors on here. I'm going to cover all 4 assets quickly. There is you should have received the Q2 investor performance report, a PDF. It will be attached to the replay email. It's also available on the page that you used to sign up for this Zoom meeting. So make sure you go take a look at it. It has in-depth numbers in there, everything that you need to know. I'm just going to do a brief overview like we always do. And again, if you have any questions, feel free to drop them in the chat box and we'll get to all of them. Okay. So the Bronte portfolio is our portfolio in Mesa that we acquired in 2022. We've come full cycle. It's been a year. And so we're going to do like a little deeper dive into it. For those of you who are listening who weren't in the deal, again, it just gives you an idea of what we like to look at and what you need to keep your finger on the pulse, essentially. So occupancy, we were able to bump it up all the way. I think Bronte West, it's a 2-pack portfolio. Bronte West has been over 96% occupied, and Bronte East is going to get to that 95% mark also. So that's great in terms of occupancy. The NOI now, if you remember, I mentioned that Phoenix and Vegas were some of the overall, if you look at the city overall, they have been seeing negative rent growth. Now, this is why I always say don't look at market pricing and don't look at market rent growth, because that's for when you don't have a value add plan. Over the last 12 months, our NOI has actually increased 22%, right? And so that's because we're doing the value add, right? And that's why the strategy comes into place. So we are seeing rent bumps significantly, and seeing that in this market makes it especially remarkable, right? Commendable. So that's positive, and we love that. Same thing, when I talked about switching to partial renovations, this is one of the assets where we switched to partial renovations. Like I said, when we're putting money into a property, it's important for us to see what rent bump we're getting. And if we're getting a higher rent bump by doing a smaller rehab, and that's what we're doing, on average, we are seeing so we want this number to be about 15%, right? So when we're doing it with this asset, we've been seeing close to 30% ROI increase, close to 30% ROI, return on interest, for the money that we've been putting into the rehab. And that's what's important to note. And that's a very, very, very healthy number. And we're happy about that. Now, that being said, I would say that the Mesa portfolio did have impact from the overall economy. The interest rates going up, we did have a rate cap on this deal when we got our debt, but the interest rates going up really fast made us hit that rate cap really rapidly. What happened is that our debt servicing costs went up sooner than expected, and then we also had to deal with delinquency. We're doing way better as far as that is concerned. Like I said, rental rates have cooled in Phoenix. Despite that, we've been able to push up rents close to 20%. So it's good. But the overall economy hasn't been as supportive as far as this particular asset has been concerned. That being said, we have been able to still execute the business plan. That's why we've been able to do well. Insurance renewals, that's again, like I said, across the country, insurance property taxes have gone up, and they are significantly affecting, NOI bumps. So that's where we are. But that being said, we've still done really, really well. Like I said, again, the switch to partial renovations has been super helpful. All of this data is in the performance report if you want to go take a look at it. Again, this just shows you that despite what we're seeing in the overall economy, we have been able to push rents up. So that's a very strong positive over there. Occupancy, we've been able to maintain it up high. So that's like maintaining occupancy above 90%, ideally above 95%. That is going to hit it's going to affect our net operating income significantly. So we've done really well with that. That being said, overall, over the course of the last 12 months, like I said, rents have been up, the NOI has gone up, the net operating income, right? So that factors in expenses also. So factoring in the increase in expenses, we've still been able to boost our net operating income by 22%, which is great. DSCR, we've also increased that from 80% when we acquired the asset to 95%. And so we're on track to getting a DSCR above 1, which gives us multiple options in terms of refinance, right? And then the plan is to increase the net operating income by another 50% by the time we're done with executing the business plan. And so that'll give us multiple options when we are looking to exit. Now, for those of you in this deal, you know that we have paused distributions, and a big reason has been to hold on to a larger cash reserve. That is just the conservative thing to do in this environment. Like we said, as much as possible, we're using our cash reserves to do our rehabs. We're also titrating our rehabs and looking to see if we need to do partial or complete rehabs. GW Capital and RSN Property Group we haven't taken asset management fees or construction management fees to date with this asset. For those of you where the distributions have been missed, you are accruing them. And all of those missed distributions will be caught up on sale, or if interest rates start dropping rapidly and we start seeing some relief in terms of the debt service payment, we'll start seeing those distributions restart again. But that's where we stand, and I wanted to give you an update so you can see that. If you look at these charts, NOI has been trending up. Everything's heading in the right direction. In terms of job estimates versus actual cost, again, there has been huge cost cutting happening. So we're possibly at 50%, expending 50% of what we need to. And again, that's just to keep a higher cash buffer at hand. So again, images of our rehab. We're heading in the right direction. I just wanted to give you updates. If you have any specific questions, always feel free to reach out to us. And then, like I mentioned, the more specific data, is available in the PDF, and you have access to it. And if you don't, feel free to reach out to us. And you can send us an email at admin@gwcapital.com, and we'll make sure we send it out to you. Okay. Moving on to Pelham Place. Pelham Place was the asset that we acquired in Greenville, South Carolina. This particular asset was appraised at a 40% higher value right after we, acquired it, right? So again, huge built-in equity over there. And we've been making tons of progress over here. Again, the same thing, rents are cooling. So vacancy and leasing concessions, we're getting to the point where we're seeing an uptick over there. That being said, we're still seeing positive rent growth, and that's what we want to see. We are, again, like I said, trying to look at whether doing a rehab is actually going to give us that bump in rent. And so we're titrating it real time. But wherever we have been doing it, again, we're seeing 25% that ROI for the money we're putting into rehabs. That is excellent. We want it to be above 15%. So again, the business plan is being executed solidly. Like I said, we did see some concessions, and the early summer, the rent growth wasn't looking great, but we're back up to where we're able to push it up. Again, over here, we haven't been as aggressive with rehabs until we know that it's actually going to give us the rent bumps that we want to see. Occupancy has been a little bit of a pain point over here. The goal is to, again, hit greater than 95% occupancy. We're working closely with property management. We are pre-leased to 98.8% and 93% for North and South. Again, this is a 2-pack. So the pre-lease numbers are looking very strong, and we are closely monitoring that. On the positive side, this is something we talked about previously. Because we are providing affordable housing over here, this is one of the assets where we are getting a greater than 60% savings in terms of property taxes because of the fact that we're providing affordable housing. And that's something we were able to execute. It was part of the business plan. We've executed it. We've also increased the value of the asset by close to $1 million because of our water conservation project. We're beginning to reap the benefits of that. All of that is definitely it's exactly what we wanted to see. It was part of the plan, but it's nice to actually see those numbers work out. Like I mentioned, vacancy is a pain point over here. We're working hard on getting it up to 95%. Class A investors in this deal will get what they were promised, the 7% preferred return. Class B and C investors are getting distributions based on cash flow at hand. If you have any questions about distributions, all of you should be set up to receive them directly deposited at this point, because this is an asset we've been holding for quite some time now. But if anyone has any questions, feel free to reach out to us. Again, same thing over here, where the actual cost of rehab is it's less than 50% of what our projected cost was. We're going in and only titrating the rehab to the point where the numbers actually make sense. So we're doing it real time. And so, and that's, for the current environment, that's going to be super critical to stay on top of those things. NOI is trending in the right direction. We've seen a bump in NOI from 318,000 in the first quarter to 423,000. So it's moving in the right direction, despite expenses increasing and despite cooling of rents overall. So we are moving in the right direction. I really, really love the direction that our designers are taking the rehab. There are more pictures in the PDF, so feel free to go take a look at it. Let's quickly wrap up by talking about the two assets we have in Atlanta. Those are our last two acquisitions. Again, the solid institutional class assets. Eagles Landing, many of you are in Eagles Landing. We locked in agency debt at 5.3% of the tight rate cap. And this was, again, purchased at 20% discount, both of those assets. Occupancy, we were able to bump up occupancy so we've had it for less than 6 months. The first year is a turbulent period per se, just because we're trying to get occupancy up. We're trying to do rehab, restart rehabbing properties, push up rents, and we're also trying to get rid of delinquency. We've been doing great. I actually met the property management team when I was there, I think it was a few months ago, and they're really on top of, they're using AI. They're really on top of working with employers in the area and bumping up occupancy. It's gone up from 88% to 93% and 97% pre-leased. Great numbers. Delinquency is also dropping significantly. Everything's trending in the right direction. We're not going to see huge uptick in NOI yet, just because we're stabilizing the asset per se, but everything's moving in the right direction. Full distributions have been going out to all members, and hopefully all of you are set up with direct deposit. Same thing with McDonough, which is now Elevate Green. Again, this is something we acquired, 252 unit, 2005 build, 3.6% fixed interest rate, and we closed it in March 2023. Delinquency is down over here. Occupancy, we're working on it. We're at 92% pre-leased. Obviously, the goal is to get us to, greater than 95% occupancy. Again, over here, full distributions have been going out, and hopefully you're all set up to have those direct deposited. If you have any questions, feel free to reach out to us, admin@gwcapital.com. And the actual full numbers for occupancy, NOI, everything's in the PDF. You should see it in your portal. And if for any reason you're having difficulty, reach out to us. We can send you a copy. It should also be attached to the last email you got and the next email you will get with a replay. So you can find it on there also. Again, an asset that we're just beginning to stabilize. So right now we're focusing on reducing delinquency and getting occupancy up. Okay, we're almost going to wrap it up and go on to questions. I wanted to mention, for those of you who are interested in learning more about real estate per se, investing in it the right way, but more directed towards those who want to directly own real estate, we have our 10X Financial Freedom event coming up in September, the first and second week of September. It's a 3-day live event. We have thousands and thousands of physicians who join us for the event every year. It's run it twice a year. Last year, we also had the Physician Freedom Summit. So those are the live events we do. I think last year we had 5,000 physicians live on our events. This year, we're hoping to far exceed that. But if you are interested in learning more, I think it's definitely a great learning experience. I'm going to talk a little more this time about how, in the current environment, with interest rates being the way they are, how do you build a recession resilient portfolio that still helps you hit those targets and gets you to your goals in terms of cash flow. And returns overall, that could be from tax savings, that could be from bumping up returns, bumping up the property value and controlling what you can control. So anyone interested, definitely sign up for it. It is generationalwealthmd.com/event in lowercase. And this time we also have some of the physicians have actually gone through our program, Creating Generational Freedom. We'll be talking about, midterm rentals and how they're tapping into that. Short-term, with midterm rentals, they can 4x their cash flow, right? With the same property. Short-term rentals, some of them can get 100% ROI just from tax savings in year one. So we're having some of our physicians talk about that. Some of them have actually used creative financing strategies like we just talked about, the loan assumptions, but for their personal portfolio. And so they're going to talk about that. Mary's going to be talking about that. Sadhna is, again, someone who started off thinking she wasn't really good at real estate and she wasn't good with numbers, to now owning, between her and her daughter, they did the one-on-one program together. They own 3 properties and they're self-managing short-term rentals. They're just crushing it, getting the tax savings. So just wanted to have you listen to more people and their stories to see what's made sense for them. Jeffrey and Michelle, they went from like 1 property to 9 properties in a short span. Just physicians who are just taking control. And I think it's a great opportunity to just come and listen to their stories. We love doing in-person events. I think we had 3 major in-person events this year, one in Vegas, one in the Bay Area where we actually went to this beautiful vineyard and it was amazing. And we had one in Salt Lake City. We're hoping to host 1 or 2 more in-person events this year. We'll send out emails as soon as we have those on our calendar. But if you have any suggestions, we're more than willing to feel free to reach out to us and we'll try to get something together. But we're done with the presentation, with the slides, and I want to get to Q&A. So let's just see if anyone has questions. If you're on here with me, CJ, can you go into Facebook, and if there are any questions over there, just drop them in the chat over here. And anyone on here live who wants to, you could just raise your hand, and we could just talk. That's the whole point of running these as Zoom meetings and not webinars. Okay, awesome. Let's see. Do we have any questions? Okay. So David, you have a question about 1031 rollover investments. Yes, there is a limit though. Traditionally, your 1031 equity amount that you're transferring into the syndication needs to be, I believe, about 500 to 750,000 for us to be able to. We like to structure them as a tenants in common, a TIC structure when you're doing a 1031. Typically, in the past, we've had to have a limit of 500 to 750,000 for you to bring in a 1031 investment. But if that is the case, then yes, we can do it, and we do try to structure it as if you're doing a 1031 as a limited partner, that's perfectly fine. You could do it with any amount as long as the timing matches up. But if you are trying to get into a TIC structure, a tenants in common structure, then we need the 1031 equity amount that's rolling in to be at above $500,000. That's how we've done it in the past. I hope that answers the question. So Mari, your question is, what kind of deals and lenders allow assuming existing rates? Are these generally for larger deals? Now, like I said, Mary, one of our students, she did that for a single family loan where it's called subject to. So you're able to assume the loan that the seller has, and it is completely legal, but there is a way where you want to structure it. With smaller deals, you want to make sure that you do get title, because that's the only way you can get tax benefits, right? So you want to make sure you're structuring that correctly. And then how you approach the lender and what you disclose can be a little tricky also. So definitely, I would just say hop on the 12th of September, and Mary's going to go over this in detail, but it can be done for smaller deals. With larger deals, both of the loan assumptions we did were with Freddie Mac agency debt. And so, yes, they will allow you to do it. It does depend on the credibility of the operators, and that's something they will look at for that. And the paperwork can be a little intense, but you can do that for smaller deals and for larger deals. So David, we do issue K1s for each of the assets, and they're going to be asset specific. So each asset will have its own K1 sent out. Hey Kuwait, thank you for joining. So we have another question. What class of investments is available for Park 33? So Class A unfortunately closed out within the first, I think it was within 24 hours of us actually talking about the deal after the investor webinar. It was less than 24 hours after the investor webinar. And that's because there's a smaller allocation to Class A. I believe it was a $1.5 million raise for Class A as opposed to a $15 million overall raise, right? And so there is a huge demand for Class A, and that gets filled up really fast. It's for Class A is for those investors who really are not really concerned about velocity of growth. It's for those investors who are concerned about consistent cash flow hitting their bank accounts. I think we were at 9%. So you get that 9% prorated hitting your bank account monthly, right? So our distributions with both the Atlanta deals and the Park 33 is monthly distributions. And so you get that hitting your bank account monthly. And some of our investors really, really like that. Class B is more for the investor. And I'd say this is more for people in their 30s, 40s, and maybe even early 50s. If you're not looking to retire within the next 5 years, Class B may make more sense for you. That's where you're getting cash flow. And for our Class B investors, projected cash flow is at 5% year one, and then it goes up to 7%. But then you get that, you also get profit on sale. And so the combination of that boosts your IRR, your returns up. And it's for those who are interested in velocity of growth, right? So we have that. We also have Class C, which is reserve class. And for Part 33, reserve class is a minimum of $500,000 investment. You get a more favorable profit split. And so that definitely boosts your returns up, but it does require you to go in with a higher investment amount. So that, yes, Shri. Oh, hi, Shri. Okay, I just saw because it said S iPhone, and then I saw your name in there. Perfect. So we do have Class B. Like I mentioned, there are a few Class B spots left, and it's only Class B that's available at this time. And so, yes. So Mayank, how does what you do differ from something like CrowdStreet or other similar platforms? That's a great question. So CrowdStreet, you're able to, let's talk about pros and cons, right? So CrowdStreet, you're able to go in with, so this is based on my understanding of CrowdStreet, right? So don't quote me on this, but my understanding is you go in with a smaller amount, right? So you don't have, with our investments, it's a 50,000 minimum commitment, right? So you go in with a smaller amount, and oftentimes they pick the assets that you're going into. There are huge transaction fees in there that you don't see. What essentially happens is that, you have the, I believe with CrowdStreet, you have the ability to exit, when you want to, so you can enter and exit as you please. I believe it is similar to REITs in that sense. I'm not 100% sure. But what happens is that if you look at your overall returns with CrowdStreet tend to be significantly lower. And that's because of those layers of fees and that are in there, as opposed to a traditional syndication model that is asset specific, even for a fund, right? If it's a fund with multiple assets in there. What happens with syndications, and so I don't really consider REITs and CrowdStreet as where the spectrum begins for me, in my opinion, because for me, if I'm getting with a REIT or I believe even with CrowdStreet, you get 8 to 12% returns. That's average returns, right? We're not talking about in this environment. We're talking about average returns. That's where you end up being. Now, I'm not sure if CrowdStreet is tax efficient or not. REITs are not. So the distributions are taxed. So again, whatever you're getting is you're paying marginal taxes on it, right? I'm not 100% sure about CrowdStreet, but those returns are very similar to what you would get in the stock market. And then real estate for me, some people look at it as diversification. For me, real estate is more about returns. Am I getting significantly higher returns? And because that's what is going to, like I said in the beginning of the presentation, it's about what's going to propel me to financial freedom, right? And so if I'm getting 8 to 12%, then that's not necessarily moving the needle for me more so than S&P 500 index fund, right? And so that's where I feel syndications, because there's more transparency, exactly what the asset is and what the financials are. There's way more, you get to pick the asset, and the split is definitely more favorable. The value add plan is over there. Once you put all of that together, you can pick whether you're going into development or you're going into stabilized value add, right? So you can pick the asset based on your risk return profile, and your returns tend to be about twice what you would get from REITs. And I believe it's also twice what you would get from CrowdStreet. So although REITs and CrowdStreet will probably say you can enter and exit at any point, I know that some of the bigger players in the last year have restricted people from withdrawing from those assets and actually selling or liquidating them when they need to, because it could lead to something similar to a bank run, right? So they're not as liquid as you think they would be. That's how I tend to look at it. And that's why CrowdStreet doesn't make as much sense to me. Now, that is based on my understanding. So hopefully that makes sense. So we're essentially talking about the returns being significantly lower, it being tax inefficient. And that's the downside to CrowdStreet or REITs. I guess the upside would be a lower initial investment and then the ability to potentially for it to be a little more liquid. But like I said, again, that's not guaranteed. So Solomon, your question is, what is the minimum investment size for GW Capital is a specific assets. We're not a fund. We haven't gone into the fund model yet, right? So we're more about specific assets. And so the minimum investment for either of those classes A and B is $50,000. And if for Class C investors, we're looking at Class C is when you get a more preferable. So you're going from a 70-30 split where our passive investors get 70% of the returns at sale compared to operators getting 30%. That split goes to 80% once you get into Class C. So the minimum investment is different for that, but otherwise it's 50,000. Hi, Najib. Oh, yes, Najib. You asked about the UBIT taxes. So great. I'm glad you brought it up. I think there was another question you had in your email. So the question Najib asks is, can we talk about UBIT if I invest in a syndication through a self-directed IRA? Is it still worth it after paying the tax, or would it be better to do deals such as your Class A? Now, that's a great question. Now, the UBIT taxes, just to explain it, I believe it's unrelated business income tax. And UBIT taxes are if you invest in real estate through an IRA, right? Through an IRA. And if you're using leverage to acquire the asset, that's when you get penalized for acquiring leveraged real estate within an IRA, because now you have to pay. When you use leverage, you're up to 6xing your returns, right? And so the government says if it's within an IRA and it's tax deferred and you're using leverage over there, then that's unfair. So what they do is they levy taxes upon your profits, and they're called UBIT taxes, right? And that's specific to leveraged real estate within an IRA. Now, so the question is, a lot of our investors like using IRA funds to invest in real estate. And if you did that to own a property that you own directly, yes, you'd be subject to UBIT taxes. Now, the way we like to structure our syndications is that as long as we structure the syndication in a way where we pay taxes on it before the distributions are passed on to the investors, then our investors don't have to pay UBIT taxes, right? And so because we have it structured that way, our investors investing, at least so it's deal specific. For the last 3 deals that we've done, if you're investing in our deals through a self-directed IRA, you aren't subject to UBIT taxes. And this is based on my conversations with our attorneys and with the IRA custodians. But if you are considering specifically investing in one of our deals, Najib, I would just say, shoot us an email and let us know that you're looking at that specific deal and you'd like to use your SD IRA. And we can confirm for you that you will not be hit with UBIT taxes for that deal. That's true if you invest with any other operator. I would specifically ask them the question and have them run it by their attorneys to see if they have it structured as such. And so I guess the second part of the question is, would it be better to invest in your deals as Class A? I'm assuming you mean outside of an IRA. And so just wanted to say that if you are investing through an IRA, you as long as in that particular deal, it's structured where you won't be hit with UBIT, then you should be fine. I hope that answers the question. Okay, perfect. Hi, Rashi. Okay, you have a question. Your question is it better to have lower LTV with one property or higher LTV for 2 properties? Oh my God, I almost feel like referring you to this particular post that I have that actually answers that question. Lower LTV with one property or higher LTV for 2 properties. Cash flow is affected adversely with high LTV due to lower down payment. So higher mortgage payments. Now, is there a calculator to evaluate this? Now, Rashi, I know you're also, I believe you're part of the course, and I can't remember. If you are, Module 4 is where I actually go over the scenario. So what you're saying is, how does leverage affect cash flow and overall returns? And so we've run these numbers multiple times, right? So if you're in the right price to rent ratio, now For some properties, it's going to be different. But if you're in the correct price to rent ratio, and every market has a sweet spot for price to rent ratio, what you'll notice is that just to make it simple, let's talk about if you pay for something all cash, or if you take a mortgage on something, right? You'll get a higher cash flow, significantly higher cash flow if you paid all cash. But like if you look at overall cash flow, right? But if you, obviously you're going to get a lower cash flow if you have leverage on that property. But if you take the same amount of money, if you're putting $400,000 into one property, as opposed to $100,000 into 4 different properties, and getting a loan for the rest of it, right? In the end of the day, your cash flow will likely, depending on the market that you're buying in, if it's the right market and it has a good price to rent ratio, your cash flow from those 4 properties should be higher for that 400,000 split between those 4 properties. And your ROI, once you factor in debt payment, debt pay down, and market appreciation, will likely be, and I've run this numbers, there's actually a scenario. There's also a blog post on it. If you go to the blog section, and it talks about leverage, your overall ROI can be 6 times what it would be if you didn't use leverage. And so that's like the 2 extremes. And then a lower LTV versus a higher LTV is just going to be on that spectrum, right? That's where it is. So the thing is with conventional financing though, and so the reason, sorry, he's Solomon, I'm just going to mute you. Okay. So with conventional financing, it's safer to go in. We have some of our members going in for short-term rentals with a 10% down loan. And that's okay because you have control over that because it's a long-term fixed loan. With commercial loans, you want to be very careful with your LTV. And that's why I try to make that distinction, because you need to meet lender requirements for commercial loans. Otherwise, they can foreclose on the property. You need to have a certain NOI. You need to have a certain DSCR, and all of that becomes very critical. So with commercial loans, if you're going for a higher LTV, you need to be super conservative. You need to be cautious, and you need to underwrite very conservatively, because if your DSCR, if you don't meet your lender requirement for DSCR, then you're going to be in trouble. And so there's a difference between conventional mortgages and commercial loans, and that's where the difference is. But I'm assuming that you're talking about, smaller multifamily or something that qualifies for a conventional loan, in which case, use leverage cautiously, but there's inherently less risk when you're using conventional mortgages. So that's the short answer, and then that blog post is going to hopefully be super helpful. Hey, Quay. So when I guess your question is, what is a good target return to be doing better than investing in the market? Now, that is a layered question. So when we say investing in the market, we're talking about the stock market, right? And when I think about just pure stocks, I look at the S&P 500 returns, historic returns, but let's just look at historic returns are anywhere from 7 to 9%. So that's what you would do within the stock market. Now, the other layer to that is that if your money's in the stock market, you don't get to pull out 7 to 9% annually and live off of it, which is a mistake I made also when I was looking at those numbers initially. I was like, well, it's 10%. If I'm in the stock market, I can withdraw 10%. Your nest egg doesn't work that way. It's a 4% safe withdrawal rate, right? So that's something just an aside. But your returns are typically 7 to 9%. Now, REITs are also 8 to 12%. Your return from REITs are very close. If you look at returns over the last 30 years, right? Those returns are very close to what the stock market returns are. And people will say, well, I want REITs because I want diversification. I am of the opinion that we don't invest in real estate for diversification. We're investing in real estate because the returns are significantly higher, right? And so, and also with REITs, the distributions, like I said, are taxed. So you're paying 50% marginal taxes on those distributions. So it's not tax efficient unless you're holding it within like a tax deferred account, right? So that's a whole different ballgame. For me, when I talk about the spectrum of returns in real estate, and we're not just talking cash flow, Quay and I, we've run numbers multiple times. We're talking about overall returns, right? Over the course of that whole period. So we're talking about returns from cash flow, returns from debt pay down, returns from market appreciation and forced appreciation, where we're increasing the property value. The multiplier that we're getting for using leverage, while holding real estate, that gives us a boost in terms of what our returns are, and then inflation adjustment, right? And then the tax savings, right? So all of that together, we're looking at a combination of that. The spectrum for me starts with syndications, which are, single assets or funds, but real estate syndications, where the returns on average, if you look historically, right? So there are times when most investors have gotten a 36% IRR. And then there are times where you're at 15%. But I would say on average, that number starts at 20%. So we're looking at 20% overall returns for a Class B investor who gets to benefit from all of these things, right? So I'm just talking about an LP. I'm not talking about the overall deal ROI. We're only talking about a single individual's ROI from their passive investment in a syndication ends up being, because if you're going to compare the deal level IRR, that's just not a fair comparison, right? So I'm looking at an LP investor as Class B getting a 20% average annualized return. That's what I'm comparing the stock market return or the REIT or the crowd street return to. And that is also tax efficient, because even as a passive investor, you have the ability to structure things in a way where you're able to kick the tax bucket, you're defer paying taxes. And that's another thing that needs to be factored in, right? But even without factoring in those tax benefits, we're looking at a 20% AAR as opposed to a 9% AAR for investing in the S&P 500 index fund. And then you have the 4% safe withdrawal rate with that stock market return, because that's when you factor in inflation and when you factor in the fact that you can't hold your assets in just stocks and withdraw from it. You have to, because of market volatility, you have to shift it into a mix of stocks and bonds. That's where it pulls it down to 4%, right? That's what you can withdraw from it. But if you're if you're investing in syndications, you have the 20% AAR. And when you get to the point when you want to withdraw from it, I say, think of yourself as a Class A investor at that point. Even if you at that point want to say, don't want to invest as a Class B investor, I'm going to put everything into Class A. Going forward, you're still getting on average 10% tax efficient cash flow, because you still get to benefit from depreciation, right? So those are the numbers I look at to compare real estate to the market. And then again, that's syndications. When you start going to buy and hold real estate investing and then going into short-term rentals, mid-term rentals, and all of that, your ROI can be as high as, on average, it can be as high as 200% year one and 70% they're going forward, right? So that's what we're looking at. So for me, that's why I say when I look at real estate, it starts off at syndications as a passive investor and then goes from there in terms of how you can boost it. We talk about all of that during our 3-day free live event. That's that's the one I was talking about. Okay, so the next question is, what do you mean by 7% distribution? It's 7% of the initial investment of the investor that is prorated and given out. For our Greenville and Mesa deals, the distributions are quarterly. So if you add up the distributions for over all the quarters of that year, that ends up being 7% of the initial investment. Correct, yes. Are there investors considered part owners of the property? Yes. So all of us in all of our deals, I go in as a limited partner also. So I'm putting multiple six figures into the deal, just like you guys are. And when I do that, I get Class B shares or Class A shares, so I'll go in as an LP also in the deals where we are GPs. Where GW Capital is a GP. So what happens is that you and I then have ownership interest, right? So we have shares of ownership in the property. So you are part owners of the property, correct? Solomon, how much average percentage is typically received by Class B investors? So that's a great question, Solomon. So if you actually go to generationalwealthmd.com/Indiana and look at the slide deck, you will see there's actually, I think it's page 12, where it talks about over the course of a 5-year hold, and we always map it out for 5 years, and we could sell anytime starting year 3, but we always underwrite for 5 years, right? Over the course of the 5-year period, if a Class B investor put $100,000 into the deal, I guess your question is Class B, right? Yes, specific to Class B. If a Class B investor puts $100,000 into the deal, what is their cash flow going to be every year? And then what do they expect as in terms of ROI from profit on sale, right? And so it's going to be different for different assets, right? Like I said, if you're going into ground up developments, at the average return by class, how much is the average percentage typically received by Class B investors? So Class B investors, the first few years in a ground up development, they likely won't have any cash flow. They'll get the bulk of their return at sale. In a deal like the one we have in Indiana, it's a core plus asset, which means it's a new asset that's cash flow heavy right now. So you'll get 5% year one, projected going up to 6%, possibly year 2, 7% therefore going forward from there. But you also have what we call preferred returns, which means that you are we want you to get 7% for every year that you're in the deal. So if you don't get that in the first few years, because we're going in and executing the business plan, whenever cash flow exceeds that, the 7% that you're supposed to get in the following years, that is paid to you. You accrue that. If you got 5% in year one and you haven't just hit 7%, you're accruing that 2% that is paid out to you anytime we have excess cash flow or a capital event. And so how that would work is that I think if you're looking at overall returns for a Class B investor in a syndication, right, that is stabilized value add. Again, it's going to differ. It ranges anywhere from 15% average annualized return to 25%, I would say. And there are two important factors over there. One is going to be what kind of deal it is. So if it's a deal where there isn't a lot of value add, where we're not going in and rehabbing the property, increasing the value, that can be on the lower end of that spectrum, right? That's called a core asset. If it's going to be a deal that's a ground up development where we're building it from scratch, that can be on the higher end of the spectrum because it's a completely new build, right? But there's higher risk in that, and then there's less risk in the core asset. So that variance can be because of that spectrum. Is it core? Is it is it higher return, higher risk, new development? But that there's variance also in terms of the economic environment that we're in. So I would say 2021, everyone was making 36% as a Class B investor, 40%, over 40%. That happened. That was the economic environment over there because home prices were going up rapidly, right? Because of inflation. In the current environment, I would say if you're seeing 15% average annualized returns as a Class B investor, that's a good number. That's a solid number for a conservative deal that is that's already cash flow positive. So that variance exists depending on the kind of deal that you're going into, low risk, low reward, or high risk, high reward. And so there's a spectrum, right? Even within syndications. And it also depends on the economic environment that you're in. So I hope that answers the question. And if it doesn't, feel free to raise your hand, Solomon, and we can go over that. Okay. Sure. Larissa, so you're saying it's better to invest in real estate than Vanguard, is it right? So Larissa, that's an interesting question, right? So I'm saying that the returns for real estate, if you're investing in syndications or anything beyond that, right? Syndications, buy and holds, turnkey rentals, midterm rentals, short-term rentals. If you know what you're doing and you're doing it right, the returns are definitely better, right? So that's true. Now the question I think for most people is going to be, how much? I think it's going to be about asset allocation, right? So the returns are definitely higher, but your question for you is going to be, do I know how to do my due diligence, right? Do I know I'm investing in the right property with the right operators? And that's why I came up with that guide. That's the generationalwealthmd.com/guide, where you can go over, how do you do due diligence? How do you vet a market? So all of that, that education piece is important. So I would quickly, it's 35 pages, but it's a lot of images. So it's going to be a really quick read and supposed to be easy. But the second part to that is, what is your asset allocation going to be? That's the question you need to answer. So I'm a hybrid investor. The first 10 years that I was working out of fellowship, I invested primarily in the stock market because I didn't know any better. But what I started doing is something called dynamic rebalancing. When I realized that my returns were significantly higher in real estate, I just started taking everything else I had and investing in real estate. I didn't really pull money out of the stock market. So the question you have to answer is, how much your allocation, right? Your entire portfolio. How much of your portfolio do you want invested in stocks? How much do you want in bonds? How much do you want in real estate? How much do you want in, say, angel investing? How much do you want in cryptocurrency? Excuse me. That's an important question to answer. I don't think I can say everything needs to be in real estate, right? I don't think that's what most people want to do anyways. If I did this differently before, would I have done it differently? Possibly. I would probably have a much, much lower allocation to stocks, but I'd probably have some money in the stock market, probably my 401k, my retirement accounts. I'd have some money in the stock market. So the important question for you is going to be, what does your portfolio look like right now? And as you're balancing it, right, as you're dynamically rebalancing it, or you may move money out of your stock market into real estate, however you want to do it, or if you're just going to start funneling more money into real estate, that's dynamic rebalancing. How do you want to rebalance it? What does your balanced portfolio look like end of the day? Say 3 years from now, this is what I want my portfolio to look like. I want you to start from there and then build it out. Okay, Larissa, is it better? What is better, to invest $200,000 into one property or $50,000 into 4 properties? So I'm going to assume, Larissa, that you're talking about 200,000 into one syndication, right, as a passive investor, or 50,000 into 4 deals. Now, that's a great question, because we're trying to answer 2 different things with that. When you're doing 50,000 into 4 different deals, you're thinking diversification, right? When you're doing 200,000 into one deal, you're thinking simplification. So those are 2 different things. They're 2 ends of the spectrum. And everyone's going to answer that question differently. And the answer is going to be different depending on your current portfolio and your needs also, right? I think when I started out, I probably would have wanted to do 50,000 into 4 deals. But that depends. If that's going to be, do you have $200,000 right now in your bank account? And are you looking to place it? And the question is, how much more are you going to have to place over the course of the year, right? So I think those are the important questions you need to ask yourself. If you are someone who has $200,000 today, and at the end of the year, you're going to have another $200,000 because you're going to save, and that's what you're going to have, then the question is going to be, where can I place my money today where I know it's safe, I've done my due diligence, and it's going to give me the highest return with the lowest risk, right? So then for someone who has $200,000 today, and you probably Q4, you'll have another $200,000, I would say you could put $200,000 into one deal as long as you have done your due diligence, because it simplifies your portfolio. For someone who probably makes 50,000 every year is what they have to have saved up every year, and they're just beginning their journey, I would say split it up. It's okay to split it up, right? And so what I'm realizing is that the further along I'm in my journey, it's becoming more about simplification and less about diversification, but I also know enough to make the solid choices. So I think it's going to depend on where you are in your journey. Are you just starting out? How much capital do you have to invest? And that answer is going to be different for different people, but there are advantages to both of those things. And so you can decide what makes the most sense for you. I hope that makes sense. I think that's just my perspective. I think everyone's going to have a different perspective. So Larissa, I think you have a second part of the question. What is the difference between Class A and Class B? Yeah, absolutely. So Class A investors, so in most syndications, so you'll have to remember that when we talk about syndications, that Class A and Class B crops up at 2 different places. You have Class A and Class B and Class C properties when you're talking about the property type, right? Class A property is a new build, great tenants, lots of amenities, when Class D properties are poor neighborhoods, lots of crime, really old properties, and B and C's in between, right? But when you're talking about investors and syndications, and most syndications have it structured the same way, you have Class A, Class B, and Class C. Class C is typically a reserve class where you need to go in with $500,000 or $1 million. But when you do that, you get a higher, you get a more preferable profit split, right? That's Class C. Let's talk about Class A and B. And most people are always thinking, do I do Class A? Do I do Class B, right? So Class A is when you want a Class A investor typically gets, like, let's talk about our Park 33 deal, right? A Class A investor in Park 33 gets 9% return, right, on their investment. So if they put in $100,000, they get $9,000 every year distributed to them monthly, and it's prorated, right? So at the end of the year, they've gotten $9,000 for every year they are in the deal. They don't get profit on sale. All they get is the 9% annually, but it's tax advantage. So how is that different from a debt fund, Param? How is it different from investing in, what is the other one? Say, getting 9% in an I bond, which I don't think you get anymore. But how is it different? So the question is that the answer is that on those, you're taxed on them. You're taxed on your distributions at your marginal tax bracket. As a Class A investor, you do get depreciation passed on to you. So it's still very tax efficient, right? So that's one thing. The second thing is that you don't get profit on sale, but you get that fixed income coming in. This is really helpful for those who have very low risk tolerance. People who like getting that steady cash flow hitting their bank account. People who are older or looking to retire really soon, they want to live off of the cash flow. It makes sense for those people. Now, for most of us, Class B is going to make more sense. So Class B investors in Park 33 get 7% preferred return, right? But it's a preferred return. So they're not going to get it on a consistent basis like Class A. They will get whatever they can get out of cash flow. So even though they get 7% preferred return, which means end of the day, they should have received 7% in cash flow for every year that they are in the deal, they may not get it upfront. So in the beginning, they may get 5% and then 6%. And then the third year, as the business plan is executed, they go up to 7%, right? So they get that, but they're giving up that consistent cash flow in exchange for portion of the profit at sale. And so when they also factor that in, their average annualized return is not 9% like a Class A investor. It goes up above 15%, right? So what's the advantage to it? That's meant for people who are looking for a velocity of growth. If you want your money, and this is just for Park 33 in the current environment. If you looked at a Class A investor in 2021 versus a Class B investor in 2021, the Class A investor went in, said, I'm going to do my 9-10%, getting it fixed. Fine, I don't want profit at sale. But the Class B investor who went in and said, I'm going to get a profit at sale, I'm okay with getting lesser cash flow initially, they probably walked out with a 36% average annualized return every year, right? So that's the difference. For most of us, Class B makes sense because there's velocity of growth in it. And we're not really looking to retire. If you're not looking to retire in the next 5 years, that makes more sense. So hopefully that answers the question. Now, we have a lot of investors who also do blended returns. They'll do half Class A. A lot of people in Park 33 did that. Half Class A, half into Class B, so they get high cash flow, and then they also get to benefit from the upside. And that's another way to structure it. So hopefully that answers the question. Hi, Maidali. Okay, so Class B, McDonough, Elevate Green. It is, I believe it's a 7% preferred return, and distributions are full, but we did project that year one would probably be 3.5 to 4% projected returns. Going into year two, it'll start bumping up to 5%, 6%, and then 7%, I believe. But I believe those are the numbers for Elevate Green. If you need more specific information, just shoot me an email, Maithili. I'll send you a link to the landing page, which actually has that. The slide deck actually has that, but that's to the best of my knowledge, those are the numbers. It's a 7% preferred return for Class B, and it's anywhere from 3.5 to 4% year one, slowly going up as we execute the business plan. And then that was I believe it was a 1.8 to 2x multiple, which means your money will double as a Class B investor, is projected to double as a Class B investor over the course of the 5-year period. I think it was 1.75 to 1.9, I believe, is for Class B, the equity multiple. So yes, I'm not sure if this is Shri, but the question is, do you take self-directed IRAs from custodians? And the answer is that is true. Yes, so you can invest in our deals through self-directed IRAs. If you don't have a custodian you're working with, we work very closely with a self-directed IRA custodian, and we can connect you and they can help you move things over. It's a very quick process. How many years it takes to get 100% ROI for LPs? So that's a great question. So it depends on the deal. Like I said, with most of our deals, with most syndication deals as a Class B investor, if you look at average, right, over the last, let's not say 10 years, right? But if you look at multiple market cycles, typically what it's supposed to average out to is going to be 5 years to double your money. So if you're saying 100% ROI for LPs, so at the end of 5 years, you should typically, as a Class B investor, right? Now, Class A investor, if it's a 10% ROI, then it's going to take 10 years for you to double your money, right? A Class B investor, you're typically looking at, like I said, if you average it out, you're looking at a 20% ROI. And so it should take you 5 years to double your money if all goes well, if that's the economic environment we're in and we hit projected returns. So that's the average. Now, like I said, it happened, you doubled your money and got 100% ROI in 18 months in 2021 and 22. And you may be shy, you may be at a 75, 80% ROI at the end of 5 years in the current economic environment, right, for the next few years. So there's going to be that fluctuation, but in general, that's what we're looking at. So the next question is, what do you mean when you say portion of the profit at sale? So like I said, so with real estate, it's multifactorial returns, right? So you have returns from cash flow that happens from day one, right? And then our goal is to increase the cash flow. And as we do that, we're increasing the value of the property. So a big part of where the profits come from is from increasing the net operating income and thereby increasing the property value. Multifamily properties, their value is determined by the income that they produce. So as we go in and execute our business plan and increase the net operating income, we're increasing the property's value. And so a big part of the business plan is to use leverage, right, and increase the value of the property. And we only tap into that return when we sell the property. So for a Class B investor, you're not just getting like this guaranteed return every month from cash flow. You're also getting you're you're getting less of that, actually, less of a guarantee in terms of the returns, because you're going to get whatever we have left in cash flow, but you're getting a portion of the profit at sale. So when we sell it, our Class B investors typically get 70% of the profit at sale, and the operators take 30% of the returns. That's how it's structured. And Larissa, yes, Class A and Class B investors both get to benefit from the tax advantages, and they get depreciation that's passed on to them on a K1. Now, I want to be very clear about it. The K1 for most investors, right, unless you qualify as a real estate professional, and most people where both partners are working as full-time employees and get W-2s won't qualify as a real estate professional, you will get depreciation, but the depreciation will be used to shelter the income that's produced from the property or any other passive income from taxes. So if you have passive income from any other source, the depreciation losses that you get from the syndication, you can use to offset it. So all the distributions you get from the syndications, all of that is sheltered by your passive losses. It doesn't necessarily shelter your W-2 income from taxes. I just want to be clear about that. But if you look at it over time, if you didn't have depreciation and you made $9,000 from in cash flow, like if you're a Class A investor and you get $9,000 profit in that year, if it were a REIT, you would get taxed on it and pay 50%, like 39% federal, 10% state taxes, 13% state taxes if you're in California. But because you have depreciation, you're not paying taxes on any of your on your profits from the syndication because of depreciation. That's the important thing. Well, hi, Poonam. So hopefully you've answered all those questions. Okay, Maithili, I'm glad I could answer that. Larissa, if I'm partly owner of the unit, who is making the decision for sale of the unit? So that's a great question, Larissa. Because we have possibly 100 limited partners investing in the deal, the general partners, we as the operators, make decisions about sale. Just to keep it simple, it's almost not feasible for everyone to be making decisions together. If there are in the past, we've had times where some structural changes needed to be made to the to the operating agreement. We've always reached out to our investors, asked them for their opinions. If it was something where we felt that, that input would be really valuable, we wanted the feedback. But in terms of timing the market and getting to our projected returns, oftentimes we as the operators make those decisions based on the data we have available at hand. If it is something where we do need input, we do pose it to our investors, but the general partners are the ones making those decisions. I hope that answers all the questions. Thank you guys for staying with me. Hi, Ming. Nice to see you on here. Hi, Alex. Najib, you're still on here with me. Marie, Quay, I can see you're still on here. Hopefully we've answered everyone's questions. And take care, everyone.